Same $400,000 house. Same buyer, basically. One decision splits them into two totally different financial lives.
Nadia takes the 15-year at 5.75%. Wes takes the 30-year at 6.75% and takes that extra breathing room and shoves it into an index fund instead. 15 years in, basically a coin flip. 30 years in, one of them is up $74,000. And it's probably not who you'd guess. Here's the first thing that throws people off. The 15-year loan isn't just faster, it's cheaper, rate-wise, because the bank's taking on less risk over a shorter window. Nadia's payment, $3,322 a month. Wes's, $2,594. Do the math, and that's a $727 gap. Every single month. Sitting in Wes's pocket that isn't sitting in Nadia's. Nadia's whole plan fits in one sentence. Pay more, get it over with. Done at year 15. Wes's plan takes a little more nerve. Pay less, stretch it to 30 years, and take that $727 and invest it instead. Jump ahead 15 years. Nadia's done. Mortgage gone. Zero balance. The house is just hers. Wes, he's on schedule, technically, but he still owes $293,182. 15 years of payments, and he's barely dented it, because a 30-year loan front-loads almost all the interest at the start. But, and this is the part that's supposed to save him, Wes has been feeding that $727 gap into the market at roughly 9% a year for a decade and a half. That account's sitting at $275,195. Netted out, what he owes minus what he's got invested. And Wes is actually down $17,987. Nadia's at zero. No debt, no deficit, nothing. So at year 15, Nadia's ahead. By about 18 grand. Not what most people expect. Here's where it flips completely. Nadia's mortgage has been gone for 15 years, so she takes that old $3,322 payment and starts dumping the whole thing into the market instead. 15 more years at 9%, and that grows to $1,256,928. Wes just keeps going. Same $727 gap, same 9%, except his money's been compounding for the full 30 years, not just 15. His account, $1,331,404. Both of them own their homes outright by now, but Wes is sitting on $74,477 more than Nadia. And here's the part that trips people up. Wes never put in more money than Nadia, not once. He just started 15 years earlier, those first 15 years of his $727 a month. By year 30, they're worth more than all 15 years of Nadia's much bigger $3,322 a month sprint, because money that's had 30 years to double, and double again, just beats money that only had 15. It's not about how much you put in every month, it's about how long it's been sitting there. If this is the kind of math you wish someone had shown you before you signed anything, that's genuinely the whole channel. There's a subscribe button right there. Anyway, but, and this matters, wins on paper and wins for you aren't the same thing. Wes's whole $74,000 edge only shows up if he actually invests that $727 every single month for 30 straight years, without skipping, without, I'll catch up next month, and if the market actually averages 9% the whole way, which it might not. A bad recession, a layoff, a decade of quietly not getting around to it, and that edge shrinks fast, maybe disappears. Nadia doesn't have that problem. Her extra payment isn't optional. It can't get spent on something else. It just happens, automatically, and 15 years in, she's guaranteed. Guaranteed. A paid-off house. Zero mortgage, zero rate risk. Done before Wes is even halfway. Guaranteed and optimal aren't the same word. Nadia gets certainty. Wes gets a better bet, with real risk attached. So which one's actually right for you? If you want the lower payment, the flexibility, and, honestly, the discipline to invest that gap every single month without fail, the 30-year usually wins on the math. If you want to be done, sleep better with zero mortgage hanging over you, or you already know yourself well enough to know that extra cash would quietly disappear into flights and furniture instead of an index fund. Take the 15-year, even if the spreadsheet disagrees with you. And if your rate gap is unusually wide, some lenders price the 15-year a full point or more below the 30. Run your own numbers. The wider that gap, the more it tilts toward the shorter loan. There's no universal winner here. There's just a version of you that sticks to the plan and a monthly gap that either gets invested or gets spent. Pull your own loan estimate. Compare your actual 15 and 30-year rates. Run this math for real. That's the only version of it that matters.
I run one of these real money comparisons every week. Next one's a decision almost nobody runs the numbers on before making it. If you don't want to miss it, you know where the subscribe button is.